Hello learners, welcome to C.A.S.H. In this video, we will learn what is accounting standards and why they exist. Accounting standards are the written guidelines that tell us how to record, how to measure, how to present, and how to disclose financial transactions. They ensure uniformity, comparability, transparency, and reliability. Without standards, accounts become just an opinion, not the information. So what does this mean? Uniformity means a discipline. Same type of transaction should use same framework. In simple terms, following the same accounting method for similar transactions. It is not a creativity, not a freedom, but a discipline. For example, one student writes exam answers in English and other student writes it in Hindi. The evaluation becomes difficult. Here uniformity means common language that may be either English or Hindi. Like that, all companies must choose a recognized method, not any random formulas. Accounting standards ensures same frameworks for same type of transactions. Comparability. Financial statements of different years or companies compared meaningfully. For example, you want to buy a phone. One company shows price in rupees and other company shows price in dollars. To compare this, you need some information, that is exchange rate. So with that exchange rate, you can compare which company is quoting for lower price. That exchange rate we can say disclosure. Like that, in company, if company A uses FIFO method and company B uses weighted average method, then both should disclose it clearly how they arrived and why they are using such methods, so that investor can adjust and compare. Without disclosure, comparison will be very difficult. There are two types of comparison, that is inter-firm comparison and intra-firm comparison. Inter-firm means comparing one company with another similar companies. Intra-firm means comparing the same company but with different years. Then the question arises, why comparison is needed? First, understand one thing, that accounting is not prepared for the company. It is prepared for decision makers. Any decisions are always comparative. For example, if you want to buy a phone, you will compare one phone with others, like which one is giving more RAM, which one is giving more storage, and which camera is good. Like this, you compare. Like that only, investor will compare companies. Which one will give me higher profit? Which one will give me more wealth? Like this, investor will compare. For example, there are two cement companies, both are same industries, but which is more profitable? This is called comparison. Intra-firm comparison means same company, that would be company A only, but comparing its performance with different years. For example, 2023 to 2024, whether the profit increased or not, whether the cost control improved or not, like this. Without standards, everyone uses different rules. Comparison becomes impossible. So with standards, same framework will be followed, disclosures are maintained, and adjusted comparison is possible. Accounting standards don't force same method, but they force comparability. Transparency, that means visible truth. If you buy a product, price shows rupees 1000, but later bill shows hidden charges. That's not a transparency. Accounting standards talks about disclosure of policies, disclosure of changes, and disclosure of uncertainties. Transparency is not about showing more data. It's about showing relevant truth. Reliability, that means reasonable certainty. It is not a perfect prediction, but it is a expectation based on evidence. For example, there is a shop A and shop B. Both are selling apples. Shop A uses digital scale, but shop B is using broken scale. In shop A, whenever you purchase, it weighs same every time. But shop B weight changes every time. Now, which shop is reliable? That is shop A. So this is called reliability. It is not the one promising cheaper products, but the one giving consistent and verifiable weights. In accounting, we don't show what we hope, but we show what we can prove. In accounting, these four should always work together. Uniformity, same rules, comparability, meaningful comparison, transparency, no hidden truth, reliability, trustworthy numbers. If you remove any one, then the financial statements will collapse. Now, who issues accounting standards? Many students get confused because different authorities are involved. Accounting standards are not made by just one body. Different bodies play different roles. One drafts it, one reviews it, and one notifies it, and one enforces it. The original body is ICAI, that is Institute of Chartered Accountants of India. Through Accounting Standards Board, it actually drafts the accounting standards. So ICAI is the technical brain behind the accounting standards. Central government will notifies the accounting standards under Companies Act after considering the recommendations from ICAI. So ICAI drafts the accounting standards, then central government will approve and notifies in Companies Act. Ministry of Corporate Affairs will issue notifications related to accounting standards. It acts on behalf of central government. It enforces Companies Act compliances. Then what is the part of NFRA? National Financial Reporting Authority, created under Companies Act 2013. Its role is to enforce, monitor, and oversight. It recommends the standards, ensures the compliances, and regulate the auditors. So, to summarize this, in India, accounting standards are formulated by ICAI and notified by central government in consultation with NFRA. Why this multi-layer system exists? Because accounting affects public money. It requires professional expertise and it requires government control also. So, no single body should have total power. For this reason, it has multi-layer systems. To remember this easily, we can say ICAI will prepare the content, central government will give the power, NFRA will watch whether it is followed. There is another accounting standard called Indian Accounting Standard. In short, we say IND AS. Whether to use normal accounting standard or Indian accounting standard will be decided by these things. Standards give options but force consistency, disclosure, and justification. Accounting standards don't kill flexibility, but they control it. They don't decide profit, but they decide how honestly profit is reported. Now the question arises, if standards allow choices, then what choices will company make? The answer comes from Accounting Standards 1, that is disclosure of accounting policies, which comes under the presentation and disclosure based accounting standards. If this explanation helped you, please like, share, subscribe, and comment your doubts below. See you in the next video. Thank you.